Hello, Sam.
Hello, how are you?
Yes, I'm okay. Thank you. How are you?
Yeah, good. Long time.
Yeah. We were just out of the country also. We had to go out just to take my daughter for some tests out of the country.
Uh, you went out of country?
Yeah. We went to Singapore just to get some medical opinion. And
Okay.
yeah, and just
So
came.
how's she right now?
Yeah, because that was basically about the post care after the kidney transplant, what we need to do. So we have got some kind of a guidance from them. So now we are just, hopefully we are having one donor who is matching. So hopefully if that comes up, we should be able to do it now.
Okay. Did
Yeah.
you come back to Singapore to Sri Lanka?
But yes.
Okay.
Now I'm back in Sri Lanka. Yes, that's right. Okay.
Right.
So let's kick off from where we were last time. We were on the variance analysis, and we were talking about various kinds of variances, sales variances, the sales volume and rate price variance. Then we were talking about the materials, usage and price variance. Labor, we were talking about the rate variance, efficiency variance, and idle time variance. Then variable overheads, we were talking about efficiency variance and expenditure variance. And I think we touched on the fixed production overheads, but I want to start it from there today again. So we know fixed production overheads generally under traditional costing method. How do we absorb it? What we do is we have a predetermined fixed overheads, the budgeted fee fixed overheads, or what we call predetermined fixed overheads. So already the budget, the fixed overheads are predetermined, 100,000 for example. Then we say, okay, let's take the overheads are going absorbed according to the labor hours. Then we say predetermined labor hours are 20,000. So we say 5 per unit is the amount that we will absorb for every, not 5 per unit, 5 per labor hour. If it is units, 100,000, and if they're targeted or budgeted for 10,000 units, then 10 per unit. This is 10 per unit. This is 10 per labor hour, 5 per labor hour. So either way, it's a predetermined rate. Predetermined rate. So whenever we absorb the overheads, the variance can come because your expenditure can be different from the budgeted 100,000, or the output can be different from the 10,000 what we budgeted for. So that's how the variance will come. So the total variance that comes up is basically you have to find out the overheads, the actual output into the standard overhead absorption rate. Hello?
Yes.
Yeah.
Yes.
Actual output. So let's assume that we have produced 9,000 output, not 10,000, but 9,000. So 9,000 at the rate of 10, that is the standard overhead absorption rate. 9,000 into 10, we would have absorbed 90,000. 90,000. But the actual fixed overhead incurred may be 110,000. So there's a variance of 20,000. This is what we call fixed production overhead variance. Fixed production overhead total variance. So how does the total variance come? We look at the actual output into the standard overhead absorption rate, and then we look at the actual overhead, 110,000. So there's a 20,000 difference. What we know is it's an adverse variance because we have incurred 110, but we have absorbed only 90,000. So if you remember your traditional costing system, this is what we call under absorption of overheads. under absorption. We have been able to absorb only 90,000 to our production, whereas actual cost is 110 under absorption of overhead. Right? So it can happen. On the other hand, if I produce 11,000 units, not 11,000, 12,000 units, 12,000 into 10, 120 we have absorbed, whereas our actual overhead is only 110. Then there is an over absorption of 10,000, which we call a favorable variance. So the overhead total variance is basically what is in your traditional costing under absorption or over absorption, right? That is what you must remember. Under traditional costing, what we call under absorption or over absorption is the total overhead variance what we get. But this variance, we can split it into two main things. Number one, just like in the variable overhead, just like in the material or whatever, what we call expenditure variance. Fixed overhead production expenditure variance. That is very simple. In the particular case which I said, actual overheads were 100 and actual overheads we said 110. Budgeted overheads we said 100. So the fixed overhead expenditure variance is 10,000 adverse. This is what we call fixed overhead expenditure variance. Very simple. Compare the actual overhead with the budgeted overhead. Don't look about the absorption rates or anything. The difference between the actual overheads and the budgeted overhead is the fixed overhead variance of expenditure variance of 10,000. So that is what we call the expenditure variance of 10,000. So budgeted fixed overhead, actual fixed overhead difference. Then we have something called volume variance. Fixed production overhead, volume variance. So that arises, you remember I told you, our fixed overheads are based on 100,000 expenditure and based on a volume of 10,000. So based on the volume, so we have to find out. So remember the total variance what we worked out was a 20,000 adverse. How did we get the 20,000 adverse? Because we produced 9,000 units and we absorbed at the rate of 90,000. Actual expenditure was 110,000. So there was a 20,000 adverse variance. So that 20,000 adverse variance, we know 10,000 of that is expenditure variance. That means we have overspent 10,000. Now we want to look at, okay, what is the variance due to the volume? So the volume what we did was actual output produced. Actual output produced was 9,000. What are the budgeted output? 10,000. So we are short by 1,000. 1,000 adverse variance. So we did not produce enough. We produced 1,000 less. 1,000 less. And that into the fixed overhead absorption rate. What is the fixed overhead absorption rate? 10. So 10 into 1,000, 10,000 is the variance that is arising due to fixed overhead volume variance. So the total variance of 20,000 is split into two items. One is the expenditure variance of 10,000 and the other one is the volume variance of 10,000. Both are adverse. This one, what we just looked at the actual overheads and the budgeted overhead, we saw 10,000 difference. That's the variance. Second one, we looked at the actual volume against the budgeted volume. We are short by 1,000 multiplied by the standard overhead absorption rate. We get the variance. So that's how the fixed overhead production variance is analyzed. Total variance is the overhead absorption, over absorption or the under absorption. That is being analyzed further into two areas: expenditure variance and the volume variance. Expenditure variance and the volume variance. So that's how we apply the variances here. So let's go back to our slides, what we learned earlier. So I'm talking about the variable overhead variances. They don't have so much of a problem. We know it is all about the labor hours or whatever. We can do that one. But I want to look at the fixed overhead variances, fixed production overhead, cost variance. So the amount of fixed overhead output is the standard fixed overhead cost per unit. So that is, we have a predetermined amount. 100,000 is the overhead, 10,000 is the number of units, and we say overhead absorption rate is 10. So that is your standard overhead absorption rate, right? Then the total variance is the difference between the standard fixed overhead absorbed. So we have produced 9,000. So 9,000 into 10, 90,000 we have absorbed, and the actual overhead is 110. So the total variance is 90 minus 110, 20,000 adverse variance. Right? 20,000 adverse variance. Then after that, we can further summarize. So it is if it is an underabsorption, in this case it's an underabsorption, it's an adverse variance. If it's overabsorption, it's a favorable variance. So that's how we calculate the fixed production overhead variance. Then overhead absorption rate is always based on budgeted level of expenditure and budgeted level of activity. 100,000 is the budget, 100,000 is the budgeted output. So that's how we get the standard overhead absorption rate. So if both can go wrong, one can go wrong. Instead of 100, it can be 110. Like in this case, instead of 10,000, it can be 9,000. In this case, both have gone wrong. So there will be variances arising due to the expenditure and also due to the volume. Right? So that is what the next thing what we are going to look at. So the expenditure variance is very simply the actual expenditure is different from the budget. So the actual expenditure is 110,000, budget is 100,000. So we have overspent 10,000. That is what we call adverse variance, and that is what we call the expenditure variance. Right? So that is that one. So this is the difference between the budgeted fixed overhead and the actual fixed overhead. Then we have the volume variance. The volume variance arises because of the volume differences. We budgeted for 10,000, but we ended up producing 9,000. So we have a 1,000 shortfall. So 1,000 shortfall is adverse. So that is the volume variance, and that volume variance is calculated. Underabsorbed to the actual production different from the budgeted production. So it is calculated the 1,000, the difference multiplied by the standard overhead cost per unit, or the absorption rate 10. So 10 into 1,000, 10,000. So this is what we call the volume variance. So that total variance of 20,000 was made up of 10,000 expenditure variance and 10,000 volume variance. It need not be so. It can be totally different figure. So let's look at some different figures just to get this matter very clear. Let's assume that budgeted overheads are 100,000 and the number of units to be produced are 10,000. So our fixed overhead absorption rate is 10. But let's assume our actual overheads are 90. So this is our actual overheads, 90, and that we produce, let's assume we produce not 10,000, but we produce 8,000. 8,000. So actual overheads are 90, actual production is 8,000. So now let's see how we calculate the total volume variance. So if the total variance. So total variance is simply the actual overheads are 90,000. How much do we absorb? 10 into 8,000, we can absorb 80,000 because our actual production was 8,000 into the standard rate 10, 80,000 we will absorb. So 90,000 is the actual. We have underabsorbed 80,000. Sorry, we have absorbed 80,000. So there's an underabsorption of 10,000. This is what we call overhead, fixed production overhead, total cost variance. Total cost variance. 90,000 was the actual, 80,000 was what we absorbed. So 10,000 underabsorbed. So now we must see what is the breakdown for this 10,000? So the first breakdown is the expenditure variance. So in this case, expenditure variance, you will see it's a favorable figure because we budgeted for 100,000, but we spent only 90,000. So good or bad? Good, isn't it? Hmm?
Yes.
Good. So
Yes.
10,000 expenditure variance is a favorable variance. Favorable variance. Expenditure variance is 10,000 favorable. But on the output, we have a problem. We budgeted for 10,000, but we have produced only 8,000. Good or bad? Bad. 2,000 bad. 2,000 bad. So 2,000 into 10, 20,000 bad. So you can see, even though the variance is 10,000 adverse, but the variance is made up of expenditure. We have saved 10,000, but on the production we were short by 22,000, and that brought us a 20,000 adverse variance, which is called a volume variance. So the 10,000 plus 10,000 minus 20,000 is a minus 10,000 variance, and that is what is reflected here. So your total fixed production overhead variance can be split into two: expenditure variance and volume variance. So that is what you need to know about the fixed production overhead volume variance, right? So that's basically what we need to learn about that one. So that variance, just like in the idle time thing, we can look at something called a capacity variance. So, and that can be only done if your overheads are absorbed based on hours. So let's assume that we are absorbing based on the hours. 100,000 is the predetermined overhead rate, and let's assume we are going to absorb according to 10,000 labor hours. So the overhead absorption rate is 10 per labor hour. 10 per labor hour. So in that case, the fixed overhead absorption volume variance, that volume variance we can split it up into two. One we call the capacity variance, other one we call the efficiency variance. So the capacity looks at the level of the workforce, what they work. So let's assume the actual number of worked hours are 9,000. Actual number of labor hours worked was 9,000. And let's assume our expenditure is 110,000. 110,000. So actual number of hours is 9,000. And their standard fixed overhead absorption rate is 10. 10 into 9, 90,000 is the amount that we will absorb. Actual number of hours, 9,000, and the standard rate is 10, 90,000. But what is your budgeted expenditure? Now I am comparing with budgeted expenditure. Budgeted expenditure is 100,000. So we have absorbed out of the budget 90,000. So that is what we call capacity variance. Capacity variance, right? We were unable to absorb the overhead purely because we did not have enough labor capacity to absorb. So this is an adverse variance because we worked less number of labor hours than the budget. So that is what we call capacity variance of 10,000, adverse variance. Then we look at the efficiency variance. So whether how much efficiently the people work, how much efficiently the people work. So we have to look at the number of units that they produce. How many units they produce? They produce 9,000. They produce 9,000. So the standard hours for actual production. So the actual production was 9,000. So we know for 100,000 they should use 10,000 hours. 100,000 they should use 10,000 hours. So that means for every unit they will use 10 hours. 10 hours, not 10. Not this is not the labor rate. It is the 10 hour. 10 hours they will use it. So for the 9,000, what is allowed is 9,000 into 10, 90,000. That is what you will be allowed. because you produce only 9,000, so you will be allowed 90,000. So now you must see, so that is what is allowed for you. Standard hours for actual production into the fixed overhead absorption rate per hour, 10, 90,000. Now you must see the actual hours worked, right? So the actual hours worked. So the actual hours worked is also 9,000 in this case, right? And at the fixed overhead absorption rate, 90. So we can see no efficiency problem. The problem here was we did not work enough hours. If you have worked enough hours, we could have recovered 80. So efficiency variance is 0. Efficiency variance is 0
Yes.
because they have worked according to the allowed hours, and that's all right. But of course, they did not work the enough number of hours, so there was a capacity problem, and that therefore brought a variance of 9,000 into 1090 and the budgeted. So we compare not with the actual, we compare here with the budgeted expenditure. We want to see the volume variance, how did it arrive. So we see the volume variance is 10,000 difference, and that 10,000 difference is simply the capacity and efficiency. We can put it like that. So these are the basically all the variances we can talk about on the expenditure side. So that is basically capacity, whether the workforce moved more or fewer hours than the budgeted. In that case, they worked less than the budgeted hours, right? Then they're calculated between the hours worked and the budgeted expenditure. So it is always, remember, we measure up in the budgeted expenditure, right? Then for the efficiency is whether it took more time than what was allowed or not. In this case, we can see they have taken exactly the time what they allowed, so no variance. So both together will give the fixed overhead volume variance. Now we come the marginal costing. Now in the marginal costing, if you remember, one thing what we don't do is we don't absorb the fixed production overheads. We don't absorb the fixed production overhead. That's a difference in the marginal costing. Right? That's the difference in the marginal costing. So we don't absorb the fixed production overhead. So we look at, you remember, we look at the marginal costing, sales minus material cost, labor cost, variable overheads. We arrive at something called contribution. And from the contribution, the total fixed overheads are deducted and we arrive at your profit. So we don't absorb the fixed overhead on the marginal costing basis. And therefore, there is nothing called fixed overheads are not absorbed, and therefore you will never find a volume variance for the fixed production on the marginal costing. Fixed production overhead, no volume variance. No volume variance, because we are not absorbing the overhead. So in the traditional costing, we absorb the overhead, but here we don't absorb, and therefore in the marginal costing variance analysis, we will never have a volume variance. We will have all the other variances. What are the other variances we will have? We will have materials, we will have usage, price. Labor, we will have efficiency, rate, and idle time. Variable overheads, we will have efficiency and expenditure. But on the fixed overheads, only one variance, only the expenditure variance. So that's a difference between your marginal costing variances and the total absorption costing variance. In the total absorption, fixed overhead will be further split into expenditure variance and volume variance. But in the marginal costing, you don't have a volume variance because we don't absorb the overhead. So that is the only difference you must remember when you compare the two things. So short questions, you will have this kind of question. So in marginal costing, fixed production overheads are not absorbed into the cost of production, right? No fixed, therefore no volume variance because you don't have volumes. Ignored. Then only what is reported is the expenditure variance. So that's one big difference you find. So actual and budgeted is the so this is the difference what we will find in the normal traditional costing. That's the only variance you will have. So most of the time in the examination we might be asked to prepare what is called an operating statement. So what is operating statement? Operating statement is, let's assume that you decided in your company to produce and sell 10,000 units at the rate of 5 and your sales were expected to be 50,000, and finally you will find that you have so 50,000 is the selling price, and you thought the material costs are going to be, so this is your selling price, you thought the material costs are going to be 10,000 into 2, so 20,000. This is your material cost. Then you thought labor, it is going to be for 10,000 units. Labor is going to be $1 per unit, 10,000. 10,000. And let's assume that you thought your variable overheads are also going to be for 10,000 units at the rate of 50 cents per labor hour. So 5,000. And let's assume that you thought your fixed overheads are going to be 35, another 7,500. And so you budgeted for a profit of how much? 30, 35, 42, 5 minus 50,000. You budgeted for a profit of 7,500. This is your budgeted profit. Because you said you thought you will sell 10,000 units and at the rate of 5, and you will incur materials for 10,000 at the rate of 2. You will incur labor at the rate of 10,000 at 1, and you will incur variable overheads at the rate of 50 cents, 5,000, and the fixed overheads you thought 7,500. You budgeted for a profit of 7,500. But you might find at the end of the day, on the actuals when you compare, you have sold 9,000 at the rate of 6, which is 54,000. You have spent on the raw materials. On the 9,000 you have spent on the raw materials at the rate of 250. So 250, 22,500. 22,500 you have sold. You have spent on the materials, and then the labor maybe you have spent on the 9,000 you have spent at the rate of 80 cents, 7,200, and maybe your variable overheads were 9,000 at the rate of 60 cents, 5,400. These are all actuals, and maybe your fixed overheads were something like 10,000. So this is your actual picture. So 54,000 is your actual sales, 22,500 is your material cost, 7,200 is your labor cost, 5,400 is your variable overhead cost, 10,000 is your fixed production overhead. So now we can find out the actual profit. So actual profit is going to be how much? So it is going to be 54,000 minus 22,500 minus 7,200 minus 5,400 minus 10,000. So that is basically your fixed overhead. So 8,900 is your budgeted actual profit. So you budgeted for a 7,500 profit, but you ended up with 8,900. So your management may want you to explain how come we budgeted for 7,500 and we ended up with 8,900. So you have to explain this one. This is what we do with the operating statement. So the operating statement is basically a very top level statement which is given to the management. They try to reconcile the budgeted profit with the actual profit. Budgeted profit with the actual profit. This is your actual profit. So generally, always you start with the budgeted profit. Operating statement, generally you start with the budgeted profit. So you start with 7,500 and then you want to explain each of these variances and come to 8,900. So you can tell how the 7,500 became 8,900. So that is what basically you will try to work it out and put it up and so. So the budgeted profit, this, that, and the other, and then you try to work out all the variances, and through the variances you will try to come and tell what is the variance that ultimately they had. So in this case, if you really look at, you can look at the sales variances, right? Sales variance, we know we were supposed to sell 10,000, we sold 9,000. So we are 1,000 short, right? 1,000 short at the rate of standard rate 5, right? So we have a 5,000 adverse variance arising due to the sales volume. Sales volume. We were supposed to sell 10,000. We sold 9,000. So there's an adverse variance of 1,000 and that came to the standard rate 5,000 adverse variance. So we can explain straight away, due to our sales not happening, we have lost 5,000. But on the price, we see we were supposed to sell at 5, we sold it at 6. So we got an extra 1, which is good, into the 9,000 units. So we got a 9,000 favorable variance on the sales price. Sales price. So on the volume, we were down 5,000, but on the sales price, we have got a 5,000 favorable variance. Right? So if you start with the 7,500 budget, right, when you don't get that 5,000, right, adverse variance, your profit will be less by 5,000. So this you have to deduct it from your budget, because you budgeted for a 7,500 profit, but when you have a 5,000 adverse because of your sales volume, your actual profit will be less. Correct?
Yeah.
So you have to deduct it. But this 9,000 is going to increase your profit, because that is going to bring you additional 9,000. So that is what we call sales price variance. So immediately you know, hey, we lost 5,000 on our sales volume, but we gained 9,000 on our sales price. Then look at the material variance. Material, so let's assume that we use exactly the 10,000 and the 9,000. So we can see again what was allowed. What was allowed? So we were asked to use 10,000 kilograms for 10,000 units. So we have used 9,000 kilograms for 9,000. That means no usage variance. Right? We were allowed to use 9,000. We have used 9,000. No usage variance. But we have a material price variance. We were supposed to buy it at 2. We bought it at 250. So there is a material price variance of 50 cents, which is bad. Right? We were supposed to buy it at 2. We bought it at 250. So we spent extra 50 cents. So that is what we call a material price variance, 50 cents into the actual number of units, 9,000. So we have a 4,500 adverse variance. 4,500 adverse variance. So this is what we call material price variance. Usage, no variance. Why? Because for 10,000 units, we were supposed to use 10,000 kilograms. And for 9,000, we should have used 9,000. So we have used exactly the same amount. So no usage variance. Let's look at the labor. Labor, we were supposed to use for 10,000 labor hours. And we have used for 9,000 9,000. So that means no efficiency variance. But we have a price variance or a rate variance. Rate variance is we were supposed to get it at 1, but we got it at 80 cents. So there's a saving of 20 cents. So 20 cents into 9,000, 1,800 favorable variance. which I have to add it up. That's a favorable variance. So that is my labor rate variance, because I managed to get labor at a cheaper rate, and that saved me 20 cents per hour, and that gave me. But variable overheads, I was supposed to spend 50 cents, but I spent 60 cents, so 10 cents adverse. So 10 cents into a 9,000, again 900, right? Adverse. So 900 is an adverse variance, which we call variable overhead. Again, no efficiency variance, because we have spent exactly the amount that we were allowed. Then we have the fixed overhead variance. So the fixed overhead, straight away we can put the expenditure variance without absorbing it, but we can absorb it and put it up also, because we know we were given 7,500 labor for a 10,000 output. For a 10,000 output, we were given 7,500 labor. So 10,000 output, 7,500 means the overhead absorption rate is 75 cents. 75 cents per unit. So when we produce 9,000 units, we would have absorbed 75,000 into 9,000. 75 cents into 9,000 we would have absorbed. So 75 cents into 9,000 we would have absorbed. How much we have absorbed? 6,750. 6,750 we have absorbed. We have absorbed into our production. But our total fixed overheads are 10,000. So that means there's an under absorption of 3,250. But we don't need to worry too much about all that, because we know 7,500 was what we were supposed to incur. We have incurred 2,500. So there's a 2,500 extra, which is adverse variance. So now you can see, if you add up all this, starting from the budget 7,500, we have a minus 5,000, which is the sales volume variance. We have a plus 9,000, which is the sales price variance. We have a minus 4,500, which is the material price variance. We have a plus 1,800, which is the labor rate variance, more profitable. And also on the fixed overhead, on the variable overheads, we have a 900 adverse. So 900 adverse. And also we have a 2,500 fixed overhead adverse variance. So when you deduct all that, you should be getting the answer 8,900. So that is what we do in reconciling the figures. Reconciling and showing how we have got a difference figure from the budgeted of 7,500, why we have ended up with 8,900. So that is what we will do it. Minus 2,500. So that will tell us the difference what we got, the 8,900. So this is what we do on all the time on the variances. So we looked at the figures and we try to reconcile the operating statement, right? So this is a very important statement. Most of the time our examiner will ask us to do this statement. So we start always with the budget. So it's a top variant level variance reporting. So it starts with the expected figures or the budgeted figures, and then ends up with the corresponding actual figure. 7,500, 8,900. You want to show where you went wrong. So we'll list out every possible appropriate variance and try to give it as much as possible in detail, the statement, and that is what we should be looking at. So the between the actual gross profit and the standard gross profit, or the actual profit and the standard profit, we will do a complete analysis. So variance reporting it should be reported to the top management, or it should be reported to the management at the end of each control period, example, every month. You don't wait till the whole budget is over. You do it on a monthly basis, maybe quarterly basis. It's a statement that you prepare given all the variance. So that is what variance reporting is. So basically at the very top level, you don't want all the details. So you will reconcile just like what I did, looking at the budgeted profit, actual profit, and put up all the what all the variances, and you report it. But at the lower level, for the individual managers, he might want to know his variances. So the production manager may want to know where are the usage variances, where did I go wrong. The sales manager would want to know the variances of the total variances of different price variance and the volume variance, etc. Labor HR manager may want to know the labor rate variance. The production manager may want to know the labor efficiency variance. So you prepare separate statements highlighting the variances for which they are responsible. So the variance report should be prepared as soon as possible and give it to the people so they can take corrective action immediately. If you prepare a report very delayed, that report is useless because it's not going to help you. So you must prepare a report all the time, giving the report as quickly as possible so the people can work on the variance. The purpose of the variance is not to find the variance, but to correct the variance, because we don't want variances. We don't want variance. So we want to change the situation from the variances to the thing. So that's what we do. So therefore, we will want to change the thing, right? Yeah, right. So that's basically the variance reporting. So what about the activity-based costing? So on the activity-based costing, you remember we were looking at a more detailed analysis of your overheads, particularly the overhead. Direct material, there is no problem. Direct labor, there is no problem. But it is basically to do a more detailed analysis of your overhead cost, right? So if you use activity-based costing in a variance analysis, surely it is going to give you a better picture of variance analysis, because it is something which is going to be something of more detailed into the variances. So something which the people would want to look at, and from that angle, it's something people will be more concerned, more focused, all that kind of a thing. So variance analysis is something which we do it in the activity-based costing, and that can be done. Typically in the standard costing, you can compare the actual to overhead expenditure and efficiency variances calculated. But in the ABC, you can do a further analysis of overhead. So variable overheads you can look at from different angles, because you have the cost drivers, and will need to establish standard cost. So we'll have implications of some of the variances calculated, because we are going to calculate variances according to the cost drivers. According to the cost driver. So therefore, you will have a more detailed variances coming up, and it is going to have a big impact on the variance. So that basically finishes up our standard costing, the basic variance. We have another chapter which we need to do on what we call advanced variance. But before going into that one, I want to go today into another area of variance analysis, basically the variance analysis, the purpose of the variance analysis. Why we need to do all these variance analysis, and why the purpose of the variance analysis. So this is the next chapter we are going to look at, the purpose of variance analysis or the discussion on the variance analysis. So why these things, more theoretical side of it. So the variance analysis, why it is important and all that kind of a thing. Right. So, variance investigation. So, variance naturally arises in standard costing because the standard cost is a long-term average cost. Now, that's a very important thing, right? It's not today's cost, it's a long-term average cost. So, you may not, your prices of raw material today may be $5, but the long-term average cost may be $4.50. So you have worked the standard based on the long-term average cost, not today's cost. So when you work on the long-term average, today, when you put the price 5, you have a variance of 50 cents. But although it is today 5, maybe next week it will come down to 4. So here it's a 50 cents adverse variance. Here it's a 50 cents favorable variance. So it will get squared off and you will have the long-term average of 450. So generally, variance will arise. So just because the variances are there, it is not bad because the standard is a long-term thing. But if the variances are going to happen continuously, 1 month after the other, all adverse, 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 then something is wrong. 1 month adverse, second month favorable, third month adverse, fourth month favorable, it's all right. But if it is going to be continuously adverse, then something is wrong. So, so in any given period, for example, if you take the month of July, right, the prices may be higher because in countries like in Middle East countries, the Ramazan, so there will be people buying lot of things, the prices can be higher, the sales prices can be higher, but over a period of 1 year, it will get standardized or it will get averagized. So it should cancel out in the long term. So, but if it is every time if the prices are going to be high, that means our standard is wrong. That means we have to do some correction. So the variances can arise due to poor budgeting, poor standards, right? We know that we can sell 10,000, but we have set the standard at 9,000. So we will always have variance. So that's not very good, but that is poor budgeting. Poor recording of cost, that is wrong accounting, right? Without charging the labor to labor, you are going to charge labor to, you are going to charge labor to some factory overhead, so something like that. So you will have variances because you are doing wrong accounting. Operational reason. There can be a lot of operational reasons. Although you budgeted to buy the labor at 10, you may not be able to buy it at 10. It is 12, 13 in the market. So because of that, you have to pay extra, and that is operational reason. Random factor. Something which is completely, something out of box situation. Maybe that some new product has come and the customers have decided not to buy your product or something like that. A completely out of control situation. So you must identify the reason for the variance. So if it is poor budgeting, what have you got to do? You must correct the budget. If it is poor recording of cost, what have we got to do? We must correct the recording. If it is operational reason, we must investigate and see why. What is the problem? Then we must try and take corrective action. If it is random factors, we have to see how to avoid it in the future. So the variances should be investigated, but not that all the variances at all the time should be investigated, because the variance investigation is a very costly process, time consuming, costly process. So when you want to investigate variance, you must consider certain factor. So identify the reasons for variance. So if it is your wrong accounting, don't try to analyze the variance and try to think about it, because it's nothing to do with the variance. It's your wrong accounting. So identify the reasons for variance and take the corrective actions so that appropriate actions can be taken. right? So the variance investigations will depend on many factors. So it may be sometimes it's a waste of time to investigate all the variances because they are not part of your normal business. One-off variance. So don't make a shout and a scream and a noise because they are one-off variance. Let's forget about it. If it is not material. So the factors to be considered in the variances is the size of the variance. If the variance is just small, $1, $2, $50, don't waste time. Not worth. Size of the variance. Then likelihood that the variance being controllable or its cause already known. Right? If you know, yes, we know the reason for the variance and we know it has happened purely because of this, that and the other, and we know that it's not going to happen in the future, then no need to worry about it. Then no need to worry about it. Then if it is, that means we have a control over the variance. So we don't need to worry about it. We know that variance can be set about and done the thing whatever that is necessary, right? So or we know the cause of the variance. Why we analyze the variance is for us to find out the cause of the variance. So if you know the cause, why just spend your time analyzing the variance, isn't it? Not well, right? If you know the cause of the variance, you know, oh yes, last month we had a variance because you know we had a problem and we don't need to worry about it. So therefore you have to just do it. Yeah, yeah, right. Yes. So that is definitely something. So the size of the variance, likelihood of variance, or when it is already known. Then the likelihood cost of an investigation. To investigate the variance, sometimes you have to spend hundreds of dollars. Is it worthwhile spending? What can we get out of it? But so cost versus benefit. What is the benefit you get? What is the cost of doing this thing? So that's another thing. Then interrelationship of variance. Some of the variances happen because there's an interrelationship. You know, you have bought some what? You have bought some low quality staff, low quality people, labor at a cheaper rate, and therefore the inefficiency has dropped. So you will have probably a favorable labor rate variance, but adverse efficiency variance. Why? Because we have taken cheap labor and they have taken more time. So there are interrelationships. So that also should be investigated. What was the cause for it? Is it because we took cheap labor? So that's another thing. Then the type of standard. You remember we were thinking of 4 standards. What are the 4 standards? Attainable standards, ideal standards, current standards, historical standards. So what is the standard we have set? Is it attainable standard or do we have set ideal standard or basic standard? So depending on that one, because you know if you set a basic standard, that means a history standard, always you will have variance. So not worth trying to spend time on investigation. You know there will be variance. You expect the variances to be. But if you set up an attainable standard and if there are variances, oh, that is a cause for you to investigate the variance. Why? Why? Why this variance? Why this problem? So the techniques to investigate the variance. So one way is to what we call reporting by exception. So we look at the variances, so all the variances, and we say any variance over $1,000 should be investigated. Any variance over 1,000. So that's exceptional reporting. So 100, 200, you know, those variances not reported, not investigated. But big variances like 1,000 and above will be investigated. That is what we call reporting by exception, right? So that's one way of taking the variance reporting by exception. So you must identify significant variance and those things are done it. Then another way we look at the variance is we try to look at what we call hello. Hello,
Yes,
Anna.
yes,
Yeah, yeah,
yes, yes,
yeah. Sometimes we try to look at the variances by cumulative effect. You don't want to look at the monthly variance because the monthly variance, you know, there is a variance, but you want to look at the cumulative effect. So first month target was 100, right? These are the standard, and actuals was 75. So the variance is 25. Okay. Second month standard is 100, actuals are 110, the variance is 10 plus, here minus here. So we look at the cumulative. So for the 2 months, 200 against 185, and then we investigate the cumulative variance. Not looking at one particular month, 25 and 10, but we try to look at the cumulative side of it and try to work out. So that's another technique we use. One technique is the exceptional method. The other one is basically cumulative thing. Then setting the control limits. Setting the control limit. So you can set up a kind of a expected variance. So you believe plus or minus 5% is accepted. So any variance within 5% will not be investigated. Any variance above 5% will be investigated. Any variance minus less than 5% will be investigated. So that's a way to do the variances. So you try to put up a kind of a picture of the variance. So why a particular variance has occurred. So management may want to know why this particular variance has occurred. And that's another way the various investigation takes. So you can go by reporting by exception, you can go by cumulative, you can set your control limits, or you can establish and detailedly work out why a particular variance has occurred. Maybe a particular sales rep is not doing enough. So you want to investigate and see why he is not doing enough. So when we come, so once the reasons has been established, you have to decide what you are going to do, right? So you have to decide if there are any adverse variance. Adverse variances means either you are not selling enough, or you are buying the things at a higher cost, or you are using excessive raw materials, or your labor is not productive enough, or you are paying more for the labor, or you are incurring more expenditure. So that kind of a thing, adverse variances, you must see how I can prevent it. So how I can prevent it. So how I can increase the sale, how I can reduce my material cost, how I can reduce my material cost wastage. So if you have favorable variances, which is a good thing, you must see what are the ways to repeat the favorable variance. How can I ensure that next period also I will have a good favorable variance? So that's what we call, that's the action that we want to take. If you are falling behind the budget, you might want to see what action should I take. Should I do some more advertising? Should I send? Should I change the sales reps? Should I change the procurement from particular supplier? So to bring it to the right into the budget, the kind of action that you want to do it. So variances can be interpreted. So the possible operational causes for material price variance. So the price, you remember the raw materials we are going to buy, there can be many reasons for the variance. So one of the reasons is that we have used a different supply, right? Earlier, your boss might ask, hey, Sami, why is this variance in the price? So you may want to see what is the reason. So maybe that we have changed from one supplier to the other. Earlier supplier was supplying at $9, and now we have got a supplier who can supply at $8. Or maybe earlier supplier we got it at 9, but now we have got a supplier who is supplying at $10. In that case, it's adverse variance. In the earlier case, it's a favorable way. So you want to see. Then maybe I bought large orders, bulk discount. Earlier all this time we were buying 100 kilos, 100 kilos. But last month we bought 1000 kilos, and therefore we managed to get a quantity discount, a bulk discount. And that has saved me money. Hmm? Sometimes it may be an unexpected price increase by the supplier. Supplier suddenly increase the price. Oil prices, it can go up, it can come down. So it can be because of that one. So that is why the variance analysis investigation will reveal all these things. So we know where we went wrong or where we went wrong. Unexpected buying cost, such as high delivery charges. So maybe all this time you are buying the particular product from Dubai, but now you have to export it or you have to import it from America, and that is means extra freight charges, freight, and all that is going to add up to your material cost. So the moment you see these things, you know, hey, this is where I went wrong. So we know that we have to come back and do it. Maybe efficient or inefficient buying procedure, that your buying procedure is so rusty, you wait till the last moment to purchase, you don't have reordering level, and you wait till the last moment to order, and by the time you order last moment, the suppliers know you are panic and they will charge high prices. So that is also another reason for variance. So any of these things can happen. And finally, something which we will be discussing, a change in material quality. You buy a cheaper quality material. So maybe at a lower price. Or maybe you will buy a higher quality material at a higher price. So what I want to explain to you is the variances itself are not bad. Variances will occur. But what we must try to do is to explain the variances. Explain the variance. So let's continue from here. Let's look at some more variances and analysis, and also the explanation for the variances. Anything unclear today?
Yes. Yes. Yes, it's clear.
Everything clear, good. So I'll send you this recording
Yes.
for you to go through, and so that you can have this one. Yes. So when can we meet next, Sami?
Next Wednesday, I'm free also.
Wednesday. Wednesday. What about Thursday? How are you Thursday? Thursday, how are you? Hello?
It's okay for you?
Thursday, how are you?
Hello?
Hello? How is Thursday for you? Thursday?
Hello?
Hello? How is Thursday for you? Thursday? Hello? Hello?
Yes. Yes.
Yeah. How about Thursday 6:30?
Okay. No.
Yeah. So shall we make it Thursday 6:30?
Yes. So, Thursday, right?
Yeah, Thursday 6:30, right? Yeah.
All right.
Okay. So I'll see you on Thursday 6:30. Okay?
All right. Okay.
Okay.
Wednesday, I'm free also Wednesday.
Yeah, Wednesday I have church. So let's make it Thursday.
All right.
Okay. Right.
Wednesday.
Thank you.
All right. Thank you very much.
Bye.
Good day.